Chapter 16 Fraud and Financial Crime. In this chapter, I will share with you the special topic on business and technology about fraud and financial crime. We will start by explaining what is the meaning of fraud and what are the prerequisites of fraud. And in this class, we will end by sharing with you some of examples of fraud in a business organization. And then the fraudulent financial reporting, money laundering, and implications, preventions, and management responsibility of fraud will be followed in another class. So let's start by explaining the meaning of fraud. The meaning of fraud is based on the intention, because fraud and error, we will explain later about error, but for fraud it is an intention or intentional act involving the use of deception to obtain an unjust and or illegal advantage. In other words, fraud is an intention. It's not careless or mistakes. It's just an intention act to have some benefits or advantage which is unjust or illegal, and essentially led by deception. So fraud is a criminal offense and punishable by a fine or even put you in jail. As far as the financial statements are concerned, fraud comprises both the use of deception to obtain, we just mentioned about deception to obtain above, and adjust, or illegal financial advantage, and intentional misrepresentations affecting the financial statements. So for fraud, how does fraud relate to an accountant or professional accountant? Because fraud will cause misrepresentations in the financial statements. So for a professional accountant, we need to be highly aware of the possibilities of fraud in an organization. Before we go through the prerequisites of fraud, let me explain to you what is the difference, or how fraud is different from error, irregularity, and misstatements. For error, it refers to unintentional mistakes. In other words, fraud is an intentional action or intentional act. For error, it is an unintentional, just a mistake. And error is an inevitable part of human nature. So everyone here, no matter is the student, teacher, or even professional accountant, or chief executive officer, even the president, error is unavoidable. It's just our human nature. So systems of internal checks are essential in order to prevent or detect any possible errors. So again, here we talk about the systems of internal checks. And we discussed the internal controls in another class, which is very important in any organization to detect error or even fraud, because they help to prevent or detect any possible errors or fraud. Next, irregularity. Irregularity is something contrary to a particular rule or standard. For example, the maximum cash deposit in a bank account set by the bank or set by the bank account owner, say, is $10,000 per day. In a particular day, the cash received in the bank account is, say, $20,000. It is irregular, and for that case, the cashier or the treasurer observed this irregularity should report to the senior management because it is not usual, it is not regular. Another example, say the withdrawal of cash from the bank account. If a particular bank account is just for cash withdrawal, say is for expenses, so all the items in that particular account are withdrawal. So no deposits for this particular account, except for management to put a lump sum amount into the bank accounts to restore back to the, say, initial amount. The example is, initially I put 1 million on a specific bank account for cash withdrawal or payment. And I can only see the bank accounts or items withdraw for payment or for salaries or whatever. If I spot there's any items deposit in the accounts, then it is irregularity, which the treasurer or cashier should alert the senior management about it. It's also the same on the opposite. Misstatement. Misstatement is something stated wrongly. Misstatement can arise due to fraud, irregularity, or error. So for misstatement, here, for example, the purchase invoice, the accountant has already input into the accounting system, but she forgets the input of that invoice maybe after lunch. So we input the data, the same information in the system again in the afternoon after lunch. Then it is a duplicated invoice in the system. Then it is the misstatement. In the case that I share with you, it is just an error. But sometimes it can be caused by fraud or irregularity. So, just sharing the meaning of fraud. Right now, we would like to share about the prerequisites of fraud. There are 3 prerequisites that are required for fraud to occur. In other words, we have to see these 3 conditions exist so we can see the fraud. If just 1 or 2, then the fraud may not be occurred. So the first prerequisite here is dishonesty. It relates to the lack of integrity. An honest employee will be unlikely to commit a fraud. So it's about the character of the employee or the morale of the employee in the company. Next, opportunity. If a control environment is very tight and the bank accounts, the invoicing, data input are highly controlled and monitored, the opportunity for individual to have fraud is limited. So here, the opportunity means the individual must have the opportunity or opening for a fraud to be committed. These opportunities will often be created due to weak controls or weak internal controls. So in other words, if you would like to prevent any fraud, you have to ensure the internal controls should be strong enough. And thirdly, motivation. In addition to dishonesty and opportunity, there should be motivation by the individual for the fraud to occur. The individual must feel that the rewards that can be earned by the fraud will outweigh the potential cost if they are caught. So for fraud, the amount incurred is usually significantly higher than the amount caused by the error or any other unintentional mistakes. So for motivation, it means the individual, they have their own calculation and find the rewards from fraud is much higher than the cost incurred. So they will go ahead for fraud if they have the opportunity and they are dishonest. So all three conditions here are usually required for fraud to occur. And let's see what are the conditions that indicate an increased risk of fraud and error. First, when you see the management domination by one person or a small group of people, it means that the risk of fraud and error will be higher. Why? Because the strong man or the strong person dominates the whole company, and he or she is easily manage the people to do any actions that is not favorable to the company's interest. Second, unnecessarily complex corporate structure. It's about the transactions. For example, if the transactions is too complicated, any person incurred in the transactions, they have the opportunity to steal the money from the company. And then poor staff morale. If the staff, they are unhappy about the company or even hate it, it increased the risk of fraud by them. And personnel who do not take leave or holidays. Let me explain a bit more on this topic, on this condition. When an accountant, he is processing the transactions, say for example, to reconcile the cash received by the customers with the accounting records. It's possible for the accountant to instruct the customer to pay the cash or to deposit the cash into another bank account, or even pay the cash to him directly. Because he reconciled the bank accounts with the customer invoice every day, it's possible for the accountant to steal the cash from the customer receipts and not reported the item as paid in the accounting record until the next time the customer pay it again. So the accountant can make a room for him to steal the money received from the customer and report the receipt from the next payment by the customer. It can be occurred if the accountant stayed in the office every day and he doesn't take any leaves or holidays, because he can settle the account receivables, the outstanding account receivables by the next payment of the customer. So that's increased the risk if the conditions here, the personnel who do not take holidays or leave. Lavish lifestyles of employees. It means that the employees enjoyed a lifestyle or even having the luxury style of living which cannot be explained by his monthly income. So it's possible for the employee to have fraud. Inadequate segregation of duties. It's quite clear that segregation of duties is very important. Just follow up my example, like the accountant who reconciled the cash receipts from the customers with the account receivables outstanding. If there is adequate segregation of duties, in other words, the reconciliation should be performed by the accountant and reviewed by his supervisor on a weekly basis, for example, and the senior or the supervisor can review all the items in outstanding balance as well as the bank receipts, and he or she can ask or check the accountants whether it is any risk of fraud in the daily operations. And next, lack of monitoring of control systems. As I explained before, control system is very important in preventing fraud and error. So lack of monitoring of control system means there's the opportunity for the staff or for the dishonest staff to steal the money from the company. And a lot of transactions are in cash. That's definitely risky because in the modern days, the electronic payment system is so advanced. The payment by the customer should be mainly through the electronic payment method, say for example, put deposit into the bank directly, and not through the cash payment. In other words, the cash payment received by the staff, and the staff deposit into the bank, then a lot of transactions incurred from these cash payments. In other words, there's opportunity given to the staff to be dishonest and motivate them to have the fraud with the company. And the last conditions here is the payments for service disproportionate to effort. For example, if the service rendered is very minimum but the payment is high enough, then it's unexplainable why this payment for service is so minimal for the efforts to be incurred. So if the management has established a strong system of internal control, as we said, internal control or strong internal control can help to prevent fraud, then the potential for fraud is greatly reduced. And the better the control system, the less likely it is that fraud will be attempted or will succeed if it is attempted. In other words, with a tight or strong control systems, even for dishonest staff, they cannot find any opportunity to steal the money from the company, then it's less likely the fraud will be attempted. Or even it is attempted, the opportunity to be succeed is lower. And the internal auditors will be given the responsibility to test the internal control system and to recommend improvements. So internal auditors can contribute here or even to have the value-added service to the company by providing recommendations on improvements in the internal control systems in order to avoid any fraud or error. In addition, the directors may ask the internal auditors to carry out a specific investigation into situations where fraud has been discovered. So internal auditors, they have two roles in preventing the fraud. First, as we just mentioned, they can recommend improvements in the internal control systems, given there's no fraud found. And if there's a suspected fraud case, the internal auditors can be given a task to perform or to carry out a specific investigation. And once the internal auditors involved, and they will write a report and report directly to the senior management and the board of directors. The purpose is to learn lessons for the future and ensure that such a fraud cannot be repeated. So internal auditors, apart from the recommendations provided, they can help the company to learn from any fraud case and recommend how to improve the overall systems in order to avoid any fraud in the future. So let's now move on to the examples of fraud in a business organization. And frauds can be carried out by managers, employees, or by third parties of the organization in questions. In other words, everyone related to the organizations, or those are the stakeholders, say managers, employees, and third parties, the fraud can be carried out by them, by the stakeholders. So let's see the examples of fraud in different parties. First, the management. The first fraud is the financial statement fraud. For example, window dressing and cooking the books. It means that they manage or manipulate the numbers in the financial statements. It's possible for them to do it because the motivation is about the bonus. Some companies would like to grant the bonus or shares incentives to the management team when the company's profits achieve a certain amount of profits, for example. And for dishonest management, it's possible for them to do it given they have the opportunity and the motivation to do so. The motivation is the bonus. The opportunity is whether the control environment is strong enough, and dishonesty is based on the people. Or the management can misappropriation of assets. It's the accounting arrangement. For example, the machineries in the factory, the management can claim the machines are no more useful and should be written off, for example. So in accounting records, the machines is written off, so no value. But on the other hand, the machines is not that old enough or not broken, so the management can take out the machines and resell in the market and to cash the receipt from it. So it's an example of misappropriation of assets. And for false insurance claim, for example, here, like in the warehouse, it report the goods are stolen or disappeared, and they report to the insurance company to claim for the loss of assets in the warehouse or loss of stock in the warehouse. But actually the items is not lost, and they can claim the insurance and compensate by it within the company or the organization, and they can pocket by reselling the stocks claimed as lost in front of insurance company, so they can pocket it by resell to the market. And the final here, only the insurance company suffered the loss from it. So it's a false insurance claims. And using the company's assets for personal use. It's not about, say, using your company computers to send an email, a personal email to your good friend. Oh, it's not the case. But some would like for personal use, for example, maybe to take out your company assets, and you use these assets to claim with the financing company as your own assets, and say, for example, like the car, and to try to use the car as the collateral for your personal loan. Employees. There are 4 examples the employees can do the fraud. First, false accounting within the sales system. Say, stealing cash sales and checks received. And teaming and netting means that, say, for example, today is day 1, and you the company sell $100 to the customers, and it will be received the $100 on day 8. It's just an example. On day 2, you also sell $100 as well, and receive on day 9. So how does the teaming and netting work here? because for the day 1, the $100 sales will be collected on day 8, and the same pattern for the invoice issued on day $200, the cash will be collected on day 9. If in the systems there's no proper control of the aging of these account receivables, in other words, the accountants can reconcile the cash received on day 8 by matching with the sales on day 1. Normally, he should do it, but if the teaming and netting exercise occurred, it means that the cash received from day 8, the accountant will not match it with day 1 sales. He just pocket the cash, assuming the $100 is not putting into the bank. So they pocket the cash, and because he knows the cash received on day 9 is $100 as well from day 2 sales, so he matched the cash received on day 9 to the day 1 account receivables incurred for this $100. In other words, he pocketed the $100 of day 1 sales by matching with the second sales receipt with the day 1 sales. It's the teaming and netting exercise. And next, the false accounting within the purchase systems. So, like the procurement staff, they can issue the purchase order to a company or to a supplier. The supplier issued 2 purchase invoices to them. So, for example, the company need to pay 2 purchase invoices because the supplier issue you 2 purchase invoices, but one of them is not right or is false. So, but they input into the accounting systems with 2 invoices, and the company has to pay for it, for example. So the company overpaid for the goods received because there's 2 invoices instead of 1 with the same amount. Third, skimming schemes. Skimming schemes is the fraudster diverts small amounts from a large number of transactions, believing that no one will bother to investigate the small differences individually, although in aggregate they can total to a worthwhile sum. So in other words, the skimming schemes is stealing the money or just small amounts of money from everyday transactions and trust no one can discover it. So finally, the fraudster can have a huge amount of benefits from it. And for payroll fraud, the typical example of payroll fraud is to create a dummy bank account or to create a dummy employee and in the payroll, and to set up a bank account for this employee by paying their monthly salary in that particular account. And the purpose is to steal the company's money. So for third parties fraud with the organization, first, the false billing fraud is quite straightforward by creating a bill or invoice that is not real or no such sales or transactions, so the company's just paid for buying nothing. It's a false billing fraud. Bank account fraud. In some companies, they would like to print their bank account details on the invoice for customer payment, for example. So the information such as the bank, the name of the bank account number, and the beneficiary of the bank accounts, then all these informations are put on the invoices for the customer payments. And unfortunately, sometimes the third party, they are also the supplier, for example, of the company as well. So the company needs to pay the supplier, which is the same as the customer, by check. So the third party is the customer as well as the supplier of the company. They got the bank account information as well as the signature, the signature, the specimens of signature as well. So it can create, say for example, instructions to the bank by filling a standing instruction form or standing order form to the bank to transfer the amount of money from the bank account details shown on the customer invoice. Then the bank follow the instructions because the signature is correct. So that is the bank account fraud, a typical example of bank account fraud. To avoid it, the bank account information put on the invoice is okay, but for the bank in that particular for the bank account in that particular purpose, it's just for collecting money from the customer. In other words, that you have to, the company can instruct the bank. There's no such as standing instructions to transfer the money from this bank account to any other third-party accounts. The only instructions for this particular bank account is to transfer the money back to the same company within the group or within the other bank. Another fraud is advance fee fraud. It is a trick where a company is invited to pay a modest fee upfront in the promise of being paid a large amount in the future. The typical form is an email from overseas claiming that they want to transfer a large sum of money out of the country but need some money immediately to pay the necessary fees to get the money released. Of course, under these situations, because it is the fraud, if any fees are paid, the promised large sum never materialize. So here is the advance fee fraud, the example of advance fee fraud. And the last fraud here is about the Ponzi schemes. I will explain a bit more in the following illustration. So what is Ponzi schemes? A Ponzi scheme is a fraudulent investment offer that involves paying abnormally high returns to early investors out of the new money paid in by subsequent investors, rather than from any underlying business. So, a person called Charles Ponzi, he moved to America in 1903 and set up his savings scheme in Boston, offering 50% interest in 45 days or double the investor's money in 90 days. Do you think how many people believe it? The numbers is quite amazing. 40,000 people believe it. And these 40,000 people sent money to Ponzi with a total sum of amount over 15 million US dollars for the scheme. So at that point of time, it's a huge amount of money. 1903, huge amount of money at that point of time. And finally it collapsed because it is a fraud. So it finally is collapsed. It cannot pay back to the investors, and only 5 million US dollars was returned to the investors out of 15 million US dollars collected. And the lesson learned here is that if a scheme looks too good to be true, then it is probably a fraud, or here, Ponzi scheme. In modern days, the Ponzi schemes exist, but in a more advanced or modern way. For example, some financial jargon is too difficult to understand, and it helps to confuse potential investors, claiming to earn huge profits by, say, the global currency arbitrage or hedge futures trading. And usually those schemes have no underlying business. In other words, all these schemes are just on the paper, and some of them finally collapse and the initial investors or the investors put their money in the scheme will lose all of them or almost all of them. So here the story is, don't trust for any investment scheme with very unreasonable return from it.